All right, let's dive right into this explainer. At first glance, Domo's April 2026 10Q filing looks like your standard, dense accounting document. But actually, it's a high stakes corporate thriller unfolding in real time. We're looking at a tech company literally fighting a ticking clock for its survival, with hundreds of millions of dollars on the line. So let's break down exactly what's happening. We're dropping right into the middle of the crisis here. Listen to this dramatic quote pulled straight from page 6 of their SEC filing. Management itself states there is, quote, substantial doubt about our ability to continue as a going concern. Now, if you're in the financial world, you know this is a massive flashing red light. I mean, sirens are absolutely blaring. To really get why that's a big deal, we need to understand what a going concern actually is. It's basically an accounting term that means a company has the resources to just keep operating indefinitely. So, when management slaps substantial doubt right in front of that phrase, yeah, they're legally signaling that they might not even survive the next 12 months. Section 1. A threat to survival. The root of this whole mess is sitting right there on their balance sheet. Domo's lenders currently have the legal right to demand $137.1 million, like immediately. But Domo only has $39.1 million in cash and cash equivalents sitting in the bank. You don't have to be a math genius to see the problem here. If the lenders come knocking today, the math simply doesn't work. It's a massive shortfall. Their legally required risk disclosures show this is absolutely not some hypothetical worst-case scenario. It is a stark, present reality. They plainly outline that their lenders have the right to accelerate the debt. They are formally acknowledging that right now, their fate is completely in their creditor's hand. Section 2. Q1 Financials. A mixed bag. Now, you might be wondering, is the business making any money at all? Well, the nuance here is actually super fascinating. Total revenue dipped just a tiny bit to $79.4 million in Q1 of 2026, but they actually managed to narrow their net loss down to $14.1 million. So think about that. The underlying business is still running, still pumping out nearly $80 million a quarter, even while the balance sheet is basically on fire. But, and it's a big but, that functioning business is operating in the very dark shadow of a $1.56 billion with a B dollar accumulated deficit. Sure, they narrowed the quarterly loss, but they've burned through over $1.5 billion more than they've made since the company started. To put that into perspective, that is exactly the kind of massive cash burn that leads a company to take on highly leveraged debt in the first place. Section 3. The broken financial covenant. So how did they suddenly get pushed to the brink? Well, it all comes down to what's called a financial covenant. Think of a covenant as a super strict rule in a commercial loan that says the borrower has to maintain specific financial metrics. And here's the kicker. If you break that rule, lenders get the immediate right to accelerate the debt and demand you pay them back instantly. And that brings us to the exact legal trigger of this crisis. Domo missed their minimum annualized recurring revenue, or ARR, target. According to the filing, this noncompliance triggered on April 30th, 2026. They didn't even miss a loan payment. Actually, scratch that, it wasn't a miss payment at all. They just missed a specific growth metric required by their contract, but that was enough to place them in default, basically handing the keys to the company straight over to the lenders. Section 4. Buying time. The forbearance. So with a default in place, how are they even keeping the lights on today? It's all thanks to a lifeline called a forbearance. This is just a temporary agreement where the lender says, okay, we'll delay our right to collect the debt or enforce the default. Just to be totally clear, the lenders haven't forgiven anything. That massive debt is still sitting right there. They've just agreed to hit the pause button on the company's destruction to see if they can figure out a better solution. And this pause button, it creates a literal ticking clock. Let's look at the timeline. After that April 30th default, the forbearance gave Domo until July 31st to find a buyer and sign a definitive purchase agreement. If they somehow pull that off, they then have until November 30th to actually complete the sale. But if they miss either of these strict deadlines, game over. The lenders can pull the plug immediately. Now, the filing does mention they're in advanced negotiations for a strategic transaction, but we have to look neutrally at their own warning, which is written right there in plain English. No assurance that any transaction will result from these discussions. They are literally banking their entire survival on a corporate rescue that, right now, just hasn't been finalized. Section 5. Underlying business risks. Beyond the whole ticking debt time bomb, the SEC document lays out a bunch of other really significant hurdles. They've got a constant need to manage growth and raise even more capital. They're facing intense industry competition. They have to constantly defend against evolving cybersecurity threats, which, is absolutely crucial when you're dealing with massive amounts of data. And really importantly, they operate under a dual-class stock structure. Crucially, their risk factors warn that their dual-class stock structure gives the founder and CEO, Joshua G. James, highly concentrated voting control. What does that mean for the average investor? Well, it means ordinary shareholders have practically zero influence over the outcome of any potential life-saving buyout. The CEO basically holds all the cards here. So as we wrap up this explainer, we're left staring at the ultimate unresolved tension from these documents. Can Domo actually beat this ticking clock? Will they secure a buyer and get that definitive agreement signed before the July 31st forbearance deadline completely evaporates? Or is the clock just going to run out, leaving their fate entirely in the hands of their lenders? It's a pretty stark reminder of just how fast fortunes can flip in the tech world, isn't it? Definitely keep your eyes peeled to the business wire for this one because the clock is absolutely ticking. Thanks for joining us.